Welcome to the Pro Ticker Deep Dive. Today, we are strapping in for what is, I think, being called the largest infrastructure mobilization since China's Belt and Road Initiative.
It's a huge deal. We're talking about a monumental state-directed pivot toward AI supremacy.
And it's fueled by a staggering amount of money, something like $70 billion committed to building out new AI data centers.
It's more than just the spending, though. It's a complete structural realignment. And for you, the listener, the key thing to get here is that most people, when they look at this, they just see the giants.
The Alibabas, the Tencents, Baidu.
Exactly. The big cloud hyperscalers who are driving all the demand.
And that's fair. They're the visible beneficiaries. But focusing on them, it really misses the real trillion yuan opportunity, doesn't it?
It does. It's the classic misdirection. Chips get all the headlines, but they only account for, what, maybe 25% of the total cost to build one of these digital factories.
Okay, let's unpack this then. Our mission for this deep dive is to follow that other money, to really understand where the rest of that capital is actually landing.
We're going after the unsexy but, absolutely essential infrastructure companies.
The financial plumbing, the ones soaking up that other highly profitable 75% of capital that bypasses the GPU market completely. This is where the predictable returns are being built.
So let's start with the sheer scale of it, just to frame the commitment. You're looking at cloud companies alone spending over $70 billion.
And that's just for 2025 and 2026, right?
Correct. Just that 2-year window. And to put that into a physical context, this is projected to lead to a 30-gigawatt increase in data center power capacity.
A 30-gigawatt increase by the end of 2025?
It's a 30% jump in capacity in less than a year.
Wow. 30 gigawatts is, that's more power than many small countries consume. And this isn't just companies deciding to upgrade their servers. This is top-down.
It's a state-mandated deployment. Beijing is creating a deeply, deeply protected domestic market for this build-out.
How are they doing that?
Through explicit policy. They formally banned state-funded data centers from using any foreign AI chips in new projects.
Yeah.
Period.
So if you're building a new government facility, it has to be homegrown chips.
Yes. And it goes further. They're mandating domestic sourcing across all the critical components: power, cooling, networking, everything.
So for the domestic vendors, that's just an automatic built-in advantage.
It's more than an advantage. They get lower tariffs, preferential government purchasing, and this is the critical part, guaranteed multi-year volume. It turns a competitive market into a policy-backed certainty.
So this all comes down to the why now question.
Yeah.
We've known about China's AI ambitions for years. Why this sudden, aggressive $70 billion burst?
I think two main forces really converged. The first was technological validation. You had what people are calling the DeepSeek moment back in January 25.
Right, that was the big psychological shift.
It was, because it showed the world, and more importantly, it showed Beijing, that Chinese AI labs could get to world-class model performance even when they were stuck using domestic chips. It proved the tech was good enough to bet on.
So that moment basically said the foundation is solid, now pour the concrete.
Exactly. And the second factor is, of course, geopolitics. The escalating U.S. restrictions basically forced their hand.
After the U.S. blocked access to the advanced H20 chips?
Right, and tightened the restrictions on manufacturing equipment from Dutch and Japanese suppliers. After that, domestic acceleration wasn't just an option, it became a necessity.
So this $70 billion, it's really a vote of confidence. It's the government saying, we are voting with our checkbook that our homegrown chips can do the job.
Precisely. And the workload is just staggering. They're projecting the nation's intelligent computing power will exceed 1,037 EFLOPS in 2025.
That number sounds huge, but break that down for us. What is an EFLOP?
So 1 EFLOP is 1 quintillion calculations per second. It's a mind-boggling number. This jump means they are building the capacity to run these incredibly complex AI models at a speed and a volume that absolutely demands this kind of coordinated spend.
That makes perfect sense. Okay, let's talk about the elephant in the data center, which is always power. We're seeing U.S. hyperscalers hitting major energy bottlenecks. How is China planning to power a 30-gigawatt expansion?
They're using geography and policy, and it's pretty brilliant. They aren't trying to build these things in, crowded coastal cities where the grid is already strained.
They're going west.
They're going to energy-rich western regions, places with abundant hydroelectric, wind, and solar capacity just waiting to be tapped.
So cheap, clean energy is part of the blueprint from day one.
Yes, and the policy reinforces it. Government targets are calling for 80% renewable energy sourcing at these new hubs by 2030. And this is the real lever here.
Because it lowers the operating cost.
Dramatically. Some analysts project that this level of renewable use could make their AI training costs up to 40% cheaper than American
Okay,
competitors.
hold on. 40% cheaper. That feels like an almost unbeatable structural advantage, but I have to challenge that number.
Go for it.
Does that calculation account for the fact that the domestic chips they have to use might be less efficient? If a homegrown chip needs 20% more power to do the same job as a forbidden NVIDIA chip, doesn't that just eat away at the savings?
That's a critical question. And yes, you're right. Initially, that efficiency gap does reduce the absolute saving.
Yeah.
But the models still show that the combination of heavily subsidized renewable power and the huge scale of these long-term contracts, it still leads to a double-digit cost advantage.
Even with less efficient chips.
Even with the current efficiency lag on processors like the Ascend. The goal here isn't short-term performance parity, it's long-term operational cost leadership. And the power policy gets them there.
That is a fascinating insight. It shifts the whole game from just chip performance to pure infrastructure economics. Okay, here's where it gets really interesting for anyone watching this space. If chips are only 25% of the total CapEx pie, where is the other 75% going?
Let's follow the construction money. First up, you have the digital landlords, the data center infrastructure operators.
Companies like GDS Holdings.
Exactly. They're the indispensable middlemen. A hyperscaler needs a new facility online in months, not years. GDS provides that ready-to-go physical shell, the power hookups, the land rights.
They're essentially the infrastructure leasing business for the tech giants.
Precisely. And it's not just empty space. Their utilization rates are already climbing toward 80%,
Yeah.
and they have 900 megawatts of capacity already reserved in prime markets. That's years of predictable revenue locked in.
Okay, next up. The big problem with AI, heat.
The cooling revolution, the density of these AI clusters is so intense that traditional air conditioning just can't keep up. It's incredibly inefficient.
So they have to move to liquid cooling.
It's a forced march to liquid cooling systems. And these can reduce the energy used just for cooling by up to 82% compared to the old air systems.
82%. That's a staggering number. So this makes companies like Herf Network Power and Blue Way Electric Appliances absolutely essential.
They are. They're not just selling fans, they're selling industrial-grade efficiency. The cooling infrastructure for a single hyperscale facility can be a $10 to $50 million line item.
And they capture that margin without any of the semiconductor design risk.
None of it. Now, moving beyond the physical building, you get to the nervous system. Optical fiber networking. The data has to move, and has to move fast.
AI clusters need insane bandwidth.
Immense internal and external bandwidth. We're talking about a leap to 400G, 800G, and even 1.6T connectivity. This just creates this massive downstream demand for cable makers like YOFC and Hangtong.
I saw a stat on the fiber deployment that just blew my mind.
It's unbelievable. China's 3 big telecom operators are expected to roll out over 212 million fiber kilometers in 2025 alone.
Let me put that in perspective for you. That is enough fiber to wrap around the entire planet Earth over 5,000 times in 1 year.
That kind of volume gives these manufacturers pricing power they have not seen since the big 5G build-out a few years back.
Powerful analogy. Okay, what about the last step before the chips go into the servers? The testing and packaging.
That's where you find the OSAT's outsourced semiconductor assembly and testing, companies like JC Group and Chindian Technology.
And their job is mission critical.
Absolutely. They take the raw chip designs from Huawei or Cambricon, and they assemble them, package them, test them, and get them ready for mass production.
So they're a pure service play on volume. They benefit directly from the domestic chip mandate without taking on any of the, immense financial risk of actually designing the chip.
Exactly. They're a pure volume beneficiary. Look at JC Group. Their revenue grew 19.3% year over year in 2024. That's way faster than the global semiconductor market because they're riding this very specific targeted wave.
And finally, the thing that keeps it all online, power management.
Uninterruptible power supply systems,
Yeah.
UPS. These are the systems from players like Huawei's Digital Power Division, or KIUA, and they're the absolute linchpin for reliability.
Hyperscalers need that 5 nines of uptime.
They have to guarantee 99.999% reliability. And as the government makes those mandates even stricter, the demand for these massive redundant backup systems just keeps expanding. They're the insurance policy on a multi-billion-dollar digital factory.
Okay, that paints a really clear picture of where that 75% is flowing. But this entire beautiful structure is built on policy.
It is, which means we need to talk about the bigger picture.
The bull case and the very unique risks.
If we connect this all together, these structural advantages create a powerful thesis for these supply chain companies. The bull case, the real moat, is pure policy protection.
What does that protection actually look like on the ground?
It looks like guaranteed revenue for a decade. When state-owned companies are told they have to source more than 50% of their chips domestically, that's a mandate. The government has basically built a protective wall around these suppliers.
It's a command economy directing capital flow.
And creating guaranteed sustained demand. And because this infrastructure, the fiber, the cooling, is built to last 7 to 10 years, the contracts are incredibly sticky.
So they get the reliability of a utility company.
Exactly. Utility-like cash flows, but with the growth rates of a tech company. And it's all backstopped by a political mandate. And on top of that, the goal to triple domestic AI chip output in 2026 creates an automatic demand surge for every single component we just listed.
That's the upside. It's a very compelling case. Now we have to talk about the storms ahead. The risks here are substantial precisely because the foundation is geopolitical.
They are. And the most immediate concern, the one we're seeing in market reports right now, is utilization risk.
Ah, yes. I saw the statistic and it genuinely shocked me.
It's a wild number. Reports are suggesting that up to 80% of the AI chips already deployed in some of these Chinese data centers are currently sitting idle.
80% idle. The factory is built, but the lights are off. That implies the infrastructure build-out is just massively outpacing the actual commercial workload. Why?
It's a few things. Initial software integration problems, some bottlenecks, and maybe just some over-enthusiasm from regional governments building too fast. But the result is clear.
If that overcapacity persists, pricing power evaporates.
And that leads to margin compression for the whole supply chain, especially the data center operators outside of those top-tier markets.
Which brings us to a related risk. Overcapacity from everybody else.
Exactly. It's not just GDS building these things. You have China Unicom, China Telecom. All these state-affiliated players are also aggressively building huge facilities. If too many of these come online at once in second and third-tier cities,
you get a race to the bottom on pricing.
You could see structural overcapacity by 2027, which would crush margins for smaller clients, even if the big hyperscalers are protected.
And you can never forget the geopolitical hammer.
Never. The U.S. could tighten the screws again at any moment. More restrictions on the essential Western manufacturing equipment that foundries like SAMIC rely on that could cause severe supply interruptions.
It would choke off the supply of the very chips this whole $70 billion infrastructure is being built to support.
And then there's the existential risk. What if the technological lag just becomes too much to bear?
What if the domestic chips just aren't good enough?
Right. Chips like Huawei's Ascend are improving, no doubt. But they still lag NVIDIA's top-tier chips in raw efficiency. If Chinese AI labs decide they simply cannot reach the next frontier of AI without foreign hardware, the political protection could be quietly relaxed.
And if that happens, the entire mandate collapses. The demand for all these beneficiaries just vanishes.
Instantly.
Okay, we've covered the opportunity and the threat. Let's get specific. Give us a technical snapshot of how a couple of these key players are positioned right now.
Let's start with GDS Holdings, the data center operator. They're sitting right at the epicenter of this. As of mid-November 2025, GDS is trading near $29 a share.
And what's fascinating to me is that despite these incredibly strong policy-backed fundamentals we've been talking about, the stock is still 25 to 30% below its 2021 peaks.
It suggests the market hasn't fully priced in this policy moat yet, and technically it's showing positive intermediate-term momentum. The 50-day moving average is firmly above the 200-day, which suggests institutions are accumulating. It's a healthy setup.
Okay, and what about that pure service play, the packaging specialist JSeat Group?
JSeat has been more volatile. It's actually showing a negative 11.5% one-year return thanks to broader market noise. But if you look at the chart, it's showing a classic bottoming formation.
Higher lows.
Clear higher lows over the last few months. For a contrarian buyer, that structure suggests a pretty favorable risk-reward, especially given the guaranteed domestic volume that's coming its way. It's a pure play bet on the domestic chip mandate succeeding.
So let's tie it all together. What does this all mean? You have this incredible $70 billion investment, driven not by market forces, but by a state mandate for self-sufficiency.
It means the entire investment narrative has changed. Capital's being explicitly funneled to these underlying infrastructure providers. You're looking at, boring essential businesses that suddenly have the reliability of utilities combined with the growth rates of tech companies.
And the real nature of this opportunity for you is that policy and geopolitics have taken the place of pure market logic. That makes these supply chain beneficiaries a really compelling risk-adjusted bet on China's technological ambition.
Provided they can solve that 80% utilization problem, the money is committed, the infrastructure is being built. The real question is, how quickly can the AI workload catch up? That's the one you need to keep mulling over.
See you all in the next Pro Ticker Deep Dive.